Good morning, everybody. Welcome to the Grit Real Estate first half of financial year 2022 results presentation. The results are out this morning on RNS and on market announcements. The presentation we're going through is on the website and live there if anybody needs to download it. But without further ado, we will shortly hand over to Bronwyn and Leon. Just by way of process for the morning, we will do a presentation for 20 minutes and then we shall open to Q&A. On the chat function on Zoom, you can either post your questions in the chat function, or at the end, please raise your hands and then the moderator will unmute you and you can ask your questions. So feel free to post questions through the course of the presentation on the chat, or afterwards do the raise your hand function and then we will let people ask questions as and when. So Bronwyn has a hard stop at 1:45, so we'll probably keep this to 20 minutes and then 25 minutes of Q&A. And so therefore, let me hand over directly to Bronwyn to lead us into the results presentation. Oh, you're still muted, Bronwyn.
Thanks, Darren. Can you hear me now?
Yeah, better.
You would have thought all this time on Zoom, I could have got that right. So thanks, Darren, and thank you for the introduction. Welcome to everybody that's dialed into the call today. We look forward to presenting Grit's half-year results, which both Leon and I will take you through during the course of the next half an hour. So I think just to reiterate from a Grit perspective, and I'll be getting into the detail about some of the things that we focused on over this COVID period in the team, but just a reminder that our investment strategy or business model is based on the fundamentals of strong tenants, multi-global tenants, dealing with tenants and we secure hard currency leases both in euros and dollars. We have Pan-African, multi-geographic, multi-asset class portfolio. And our investment proposition is to unlock value through the ecosystem of real estate, which includes investments into completed assets, development projects, as well as asset managing projects on behalf of some of our partners. So as we get into the presentation today, I'll take you through some of the key fundamentals specifically around the December results. So if you look at the African continent, just as a reminder, Grit has presence in North, West, East, and SADC Africa, multi-geographic, multi-asset class, focusing on rental collections, hard currencies, vacancies, occupying the portfolio, and global tenants. So this particular slide, focusing on those multi-global tenants, as you see on the right-hand side, is the key focus of the Grit investment strategy. So just going through specifically the key highlights and really what has taken place over the COVID period, what has taken place over the last 6 months, and where we see a tremendous recovery in both the portfolio as well as the balance sheet, which is really, really important. So as you can see from the key highlights here and some of the key metrics, we have seen an improvement in vacancies. We have seen an improvement in cash collections, which has fundamentally been around the stabilization of our operations. My operations team has done a tremendous job around stabilizing NOI over the COVID period, around collections of rentals, around filling up vacancies, and I'll deal specifically on the retail recovery of the hospitality as we see our hospitality tenants continue and resumption of rental payments. Balance sheet structure improvement has been a key metric for us. I'll touch on the placement that was successfully concluded the back end of last year, but the asset recycling with the announcement of both ABSA and for Place Shopping Centre, we have committed that we will be recycling a portion of the portfolio. The reduced LTV, which was an absolute key metric over the COVID period, from 53 to 41%. The debt restructure, focusing on longer dated debt, closure with some of the large financiers on restructuring our debt is a key fundamental aspect of the balance sheet. And then obviously improving liquidity, improving cash flow, the cash collections over 90, just under 95%, which we really boast around strong cash collections, even over the COVID period. the new strategic funding partners that we've taken on, both with the IFC and the preference note that we concluded. And obviously the most important thing is the resumption of dividends and simultaneously the ability to look at a share buyback program. So those are really the key themes and the semantics around the December 2022, or the H1 2022 and the focal points now for the group as we restate dividends. So a lot of you that have dialed into our presentations over the last couple of months, this has become a really, really important slide and key metric around how do we as the board and how do I as the CEO manage this business. So what you would have seen is that over the COVID period, if you look to sort of the left-hand side around the valuation, we would have seen a key kick up in LTV, which at the end of June 2021 would have been sitting just over 53%, now dropped to just over 41%. And really the key metric that drove that was the valuation or the devaluation of certain of our key assets, specifically driven around the retail and hospitality sector. So we saw just over $114 million worth of write-down on the asset portfolio. What we have seen though over the last 6 months is the stabilization of valuations. So you'll see the 6-month percentage move. There's been a significant stabilization of valuations, which is really, really key to show the COVID recovery and what we've seen specifically under retail and hospitality. And what's really important, and the key metric, was that we still managed over the sort of 12 months to grow the NOI by 3.5% by cost, significant cost management. But for this 6 months, we've actually been able to stabilize that NOI. And then really you'll see the collections have gone up now from the 92% reported previously to just over 94%. And I want to touch specifically on the hospitality and retail sectors, which were the two more contentious sectors over the COVID period. So if you look at hospitality specifically, we've got 3 hospitality groups that we currently are in partnership with: Club Med, Beachcomber, and Lux. Both Club Med and Lux have caught up and resumed all rentals to date. What you will also see that Beachcomber, BHI, has commenced paying their rentals and have caught up their current rentals in full to date. So whilst we did see the Omicron sort of market challenge over December, we've seen a huge retraction and improvement in the hospitality sector with bookings, the occupancy rates around our particular hotel groups, with the reopening mostly of the Mauritian borders now specifically for Lux and Beachcomber. So we've seen a major bounce back in the hospitality, which then is depicted in our collection rates with these particular 3 groups. If I go into retail specifically, retail has been our most complex asset class, specifically over COVID. We've lost the larger portion of the valuation. We do see that the valuation or retail recovering over the next 12 to 24 months. And already we're starting to see the green shoots. So what are we already seeing? We're already seeing NOI growth of just over 10.5% on the retail portfolio. You'll see that specifically the Zambian portfolio has seen valuation recovery. You've seen sort of our key malls now having anchor tenants now taking up occupancy, specifically in Morocco around Terra Nova Collins, in Kenya, and also obviously in Zambia around LC Waikiki coming into the mall. So whilst unlike hospitality, where we see a much quicker recovery, and we're already seeing it in the numbers today, what we see in retail is 12 to 24 months recovery. But again, what you're seeing from cash collection over 88%, as well as the NOI growth already, we're already seeing the strong operational performance of our management team and how it's now gone into the retail performance specifically. So one of the other key aspects we committed to the market was really around, what are we as management doing on the balance sheet? So specifically, one of the aspects that we looked at over the COVID period is where did we see asset classes or specific assets that had reached valuation peaks? Where did we see the ability to churn certain assets to peg valuations? So you would have seen in the market already that we have announced the disposal of APSA. APSA House is situated in Mauritius. ANFA is currently under due diligence as we speak, and we will be updating the market in due course. And we closed a transaction for a major sale and leaseback warehousing in Kenya, which really goes to the focus of the GRIT portfolio into the future. So reduction of retail, stabilization of retail, but focus on infrastructure assets such as warehousing, which was depicted by the Orbit transactions. So not only did we acquire Orbit on a sale and leaseback, but we were able to secure both preference note money as well as the IFC, who has come into the GRIT group for the first time. So we're really excited about that relationship. Going into the closure of what we completed at the back end of 2021, we did complete a capital raise, which we did on a preemptive basis, which allowed us to close just over $76 million worth of fresh equity in the midst of Omicron, in the midst of what happened over the December period. So thank you to our current shareholders and those that supported that capital raise. That, with the asset recycling, with the cash that we've taken now on from collections, it has had a significant impact on that LTV. There were two parts to the GERA APDM asset acquisition and capital raise. One was the capital raise, which was closed in December, and effectively that cash has been brought into the business. The second part was the acquisition of GERA and the asset manager APDM. And we intended on closing that by the 31st of March, and that is still underway as it currently stands. So just this is just showing where our share register looks like. You'll see that our share register in the UK is just over 37%. When we listed in London historically in 2018, it was sitting at 12%. It's just gone to over 37% now. Strong support by our UK institutional shareholders, which has been really good to see, even under the preemptive and the capital raise that we closed in December of this year. So I think for me, just on the portfolio overview, I think I just mentioned earlier what's really important just to highlight, and thanks, Darren, I see you've gone to the vacancy slide, but what's really important is the focus of the group going into the future. So where we saw the most resilience in the portfolio over COVID was really around 50% of our portfolio, which was offices, corporate accommodation to the embassies, light industrial. Those were extremely resilient pre-COVID and during COVID. The idea is that into the future, GRIT will not be focusing on retail. We will be disinvesting out of assets like ANFA. We'll be watching retail recovery on our other specific portfolio assets. But the focal point into the future will be around more infrastructure play. With our partner, now that we are partnering with GERA, which we currently own 20%, and obviously under the transaction will control 51%, it is asset classes like data centers, light industrial, additional embassy type corporate accommodation, and that will be the focal point of the group. And then just to really wrap up on the portfolio importance around operational importance. So NOI protection, even over COVID, the operational team, as I mentioned at the beginning, did an exceptional job around managing vacancies. We see an even further improvement of those vacancy numbers up to where we're forecasting now in June of 2022. But the team did an exceptional job, specifically even like under retail, around managing of those vacancies, and we continue to manage the operational performance as one of our key metrics as a leadership team of GRIT. If I can hand over to Leon. Thank you, Darren.
Thanks, Bronwyn. Just to give you a quick overview just of the highlight of the numbers, our distributable earnings sitting at 3.08 cents. You'll see the distribution per share that we were declaring, 2.5 cents, roughly an 80% payout ratio, which is the healthiest sort of ratio we're going to be looking to the future. The EPRA earnings sitting at 2.56. I think the key element there is effectively, even post the capital raise and the additional shares, we're still seeing good support there. Very key to the future numbers is obviously the escalations that we are able to achieve in our leases, with most of them being linked to either US CPI or Euro harmonized CPI, which should give us a fairly nice uptick in the rentals in the short term, although some of that will be tempered by some of the exchange rate movements which we have seen with the euro against the dollar. In terms of the total NOI and there's the property income, modest growth there of 0.8, 0.9%, which should kick up towards the end of the year as these escalations start coming through and going into the numbers for the full year impact of that. And one of the key aspects as well is obviously our cost control measures that we've put in place. EPRA cost ratio is down despite having some additional costs in this last 6 months, which is a little bit of a catch up where the maintenance on the buildings could not be conducted in terms of its maintenance programs, just as a result of the COVID lockdowns. So we're very happy with that specific number. Obviously, the contractual rental collections are something we've always been very close to, still maintaining the 95%. And what's very key there is that through this last 6 months, it was impacted by the hospitality sector for the first sort of 4 or 5 months where the rental deferments as well as the concessions were in place. From December going forward, no more rental concessions or deferments are in place, and that bodes really well for collection stats into the future. One of the key things that we really wanted to target as a board was the balance sheet strength, which led to the capital raise last year. We managed to move that LTV from 53.1 to 41.4% post the capital raise, with further reductions coming through once the GERA portfolio is actually brought on and consolidated into our numbers. We should see it between a 5 and 6% drop in LTV post that transaction being concluded. Just in terms of the actual portfolio performance, I think it's very key to highlight that the actual underlying assets in the portfolio performed extremely well over the last 6 months, showing good stabilization. We are seeing growth in all of those numbers. However, the capital raise, which was done at 52 cents, did impact our numbers by 17.5 cents. But this still represents very good value in the share price, which is trading at roughly a 40% discount to our net asset value. And hopefully the actual process of reinstituting the dividend, the very good LTV metrics which are now coming through, should translate into the actual share price performance in the months to come. Other highlights just to mention, Darren, if you can go back one slide. Obviously the cost of funding there, 5.7%, remains stable. We are seeing obviously a little bit of pressure on interest rates. However, the CPI increases will far outweigh any negative impact of that, which we see in the future. One of the other key stats to obviously look at in our business is our cost ratio in terms of the admin costs, sitting at 1.6% of our asset base, which is pretty stable. With the GERA portfolio coming in, we'll see that those reducing to lower levels as well. The one item which we just need to highlight perhaps is the euro exposure. Obviously, through this process of reducing debt, we have reduced the number of our euro facilities, which has increased our open euro position. With the volatility of the euro against the dollar is something that we need to manage carefully in the months to come. When it regards to debt in the group, obviously it's a key component of our business model. One of the key items which we've managed to secure is the total refinance of our Mauritius portfolio last year, which has all been extended into 2025. And we're currently completing the syndication of the rest of our debt. It's a very large syndication that will take in a number of our property sectors and regions. And this will create a far healthier debt maturity profile, closer to 4 years as opposed to our current 1.6 years. So these debt strategies are in place with our partner banks, and we're very happy to work with the likes of Standard Bank and ABSA, SBM, who have been great supporters over the COVID period and will continue to do so. Burgeoning relationships now with the IFC, who concluded the transaction for Orbit, provides other debt funding, as well as our move into East Africa. Should see a large addition to new banks, having already secured some funding from the Kenyan banks for some of the facilities going into the future. Just going on to the capital commitments, obviously out of the capital raise we did, there's a number of items which we are forging ahead. The Orbit Phase 2 as well as Orbit Phase 1, which is transferring at the moment, will go through in the next couple of months. Orbit Phase 1 should transfer in the next couple of days. I think the key thing for us is having sufficient capital now to inject into these projects, both the Club Med Senegal with the initial phases of the redevelopments, which was stalled due to COVID, our investment into 2 hospital projects here in Mauritius, which is quite exciting projects. And then the DIT settlement, now that the capital raise is done, we're pushing forward to close out that structure in the next few months, which will now finally get that part of the business stabilized and completely solved. So good to note that the capital that we've got is sufficient to cover all of these expenses and no longer has to be funded out of any operational sources. Just in terms of the distribution per share, you'll see there for the half year, total distributable income 3.8 cents, of which 2.5 cents is what we're declaring as a distribution, around the 80%. And to note that these figures, when you're looking at comparable to FY21, despite the number of shares issued in December, we should see these coming back nicely and providing a good stable base for strong dividend performance into the future. Just to note, 2.5 cents on our current share price is an implied dividend yield of roughly 10%. Going into the future with the repricing of the stock, which we are hoping for, to try and keep that between the 10 and 8% where it used to be historically. Ron, maybe just before you take over, just to highlight one of the key items which did actually occur in the last couple of months. Through the COVID period, we had embarked on the redevelopment of one of our industrial assets in Mozambique, in the port of Pemba. That is now completed in December, and the handover to the new tenants is underway. This is a very exciting opportunity, which is really on budget and on time. So very happy that the COVID impact did not really result in any major delays there. And does put us, instead of having one of the best facilities in the port of Pemba, which is going to support the oil works coming out of that region. Hand over to you, Bronwyn.
Thanks, Leon. Thanks for that update on Bolore. So I think obviously one of the important key considerations under the acquisition of GERA and the asset manager is that we are really excited around the pipeline. The pipeline, as I've mentioned earlier, that's really going to be focused and has been the focus of GERA under their execution over the last couple of years, has been around embassies. They successfully completed the Ethiopian embassy at the back end of last year. The Kenyan embassy is coming up for, American embassy is coming up for completion in up and coming months. They successfully completed a data center for liquid telecoms, also at the back end of last year. We are really seeing some of these exciting infrastructure type assets coming through on the GERA portfolio. So as I mentioned earlier, the data centers, the embassy type work, they have completed some office accommodation in Apollonia in Ghana itself. So again, the focal point around infrastructure assets in Mauritius itself, the GERA project team is under construction with 3 projects, 2 healthcare projects, the first specialty oncology units of its kind in that particular region, a head office up in the north, Grand Bay of Mauritius. So these projects have been successfully underway. Some of them have been successfully completed. So we are really excited around the strong pipeline, long-dated leases, hard currency leases, strong tenants that are coming through specifically in the GERA pipeline, and obviously with the up-and-coming acquisition of that particular business.
And sorry, Bronwyn, just to make sure it's absolutely clear, these are all fully funded projects. So what we acquire in GERA are fully funded projects which don't require any additional capital from GRIT. So as GRIT acquires this pipeline of portfolio assets that are coming through, no further capital required, but there is this ability to deliver the NAV growth over the coming 3 years as the rest of these projects deliver.
Thanks, Darren. Absolutely. So one of the key fundamentals, obviously for a group like GRIT, we obviously are operating in emerging markets, we're operating across the African continent. Sustainability is one of our key criteria. The pillars of sustainability that we manage our business under, and we have got 4 key pillars being carbon emissions, building efficiency, local representation, and gender equality. Through our partner at GERA, we did a fantastic campaign around the American Embassy in Kenya, a campaign by the name of Build Her. We were able to successfully complete that project with the majority of the leadership team actually being women. We were able to support a local campaign by the name of Build Her, which brings women into the construction sector, which is fantastic, absolutely shattering glass ceilings in relation to women in construction. So the GREA and the GRIT team are really proud of that specific initiative, which falls firmly under our pillar of gender equality, under our sustainability priorities. So just from a closing remark perspective, I think one of the key aspects around management of the balance sheet, reducing the LTV, was and is the resumption of dividends. So we have committed around 3 cents, and we effectively are distributing our 2.5 cents. The policy is to distribute at least 80% of distributable earnings that we generate out of net operating income back through to our investors. The resumption of the dividends is a really key metric, and one of the commitments that we made to the market upon being able to reduce our LTV below 45%. So the resumption of dividend plus the guidance around dividends going into the future, and sort of the current financial year of between 5 and 6 cents, and then the idea of being able to implement a share buyback. We still trade at a significant discount to net asset value, so the ability to use additional proceeds to be able to do that, but the resumption of dividends is really key. So as a leadership team of GRIT, what we have really committed to is some key focus areas. What is the key focus areas of what do we do as management every single day? What do we focus on? What we focus on is our real estate, the ability to generate the NOI, the ability to ensure vacancies are filled up, the ability to manage the underlying operational performance as we have successfully demonstrated over the COVID period, our ESG commitments, the ability to strengthen our group balance sheet and liquidity, which you'll see that we've already started implementing those key initiatives, asset recycling, which we've already announced under this disposal of ABSA and potential disposal of ANFA, the long-term sustainable debt strategy. We've introduced the IFC into GRIT over the COVID period. We are really excited around that DFI relationship and the expansion of other DFIs actually supporting GRIT into the future. And then the conclusion of GREA acquisition, which we would hope to implement by the end of March this year. So as a management team, we've had some really key focus areas. COVID has been a difficult economic period for many businesses. We've been able to navigate, as I dramatically say, sort of 50% of our portfolio, 25% hospitality, 25% retail, has effectively been under severe pressure under COVID, and now being able to get into the ability now to resume dividends, reduce that LTV, strengthen the balance sheet. We are really very, very happy to bring these results to the market today. So on behalf of myself and the board of GRIT and Leon that's presenting with me today, we really look forward to what is to come, and we look forward to bearing the fruits of what we have implemented thus far and to date under the GRIT portfolio. So on that note, thank you, Darren. Maybe we want to open up to questions.
Brilliant, thank you. So just to remind everybody, we will run both the function of the chat questions or raising your hands. So I think while we wait for a couple of raised hands, maybe we can go straight into the questions we're receiving on the chat. So a message, thank you for the dividend, but can you please just talk a little bit around why we sold the Mauritius office? So what was the thinking behind that? Did we want to do it to demonstrate value? So to demonstrate that our NAV is true NAV? And then also just to understand retail, why are we selling retail at this stage? So I think just a little bit about why those assets, what particularly were we trying to achieve with that, and what have we done with the proceeds as a starting point, please?
Thanks for the question. Thanks, Darren. I'll tackle that, and Darren and Leon, if you want to add anything onto that. So I think specifically around the ABSA disposal, the Mauritian office, I think goes into 2 parts. One, yes, we want to demonstrate value, which is really important. The particular value of that asset, we believe, is at its peak. The other aspect is that we, with our development partner GREA, we are developing a very large office precinct up in the north of Mauritius by the name of the Precinct, which we're really excited about. For us, we are happy that is our office exposure to Mauritius specifically. So the idea of just investing out of the area of Ben specifically, but also demonstrating valuation and demonstrating liquidity is key. Now, the comment around retail is actually really, really important. So whilst I will state, and I did, that we don't want to be invested into retail being new acquisitions into the future, our focus is on that infrastructure play specifically. We will, some of the assets which we have seen very, very deep discounted valuations coming through, our Zambian portfolio, some of our other retail assets, we do want to wait and see recovery around those assets. And we do believe we've even seen recovery in the last 6 months. ANFA specifically has been an asset that is quite complex for us. It is a not to our traditional retail type investment. The retail model for Grit is strip mall, convenience, servicing a very large population, and something like ANFA, which is the closed mall retail, situated in Casablanca. Closed mall retail has been a lot more challenging over the years. It takes up a lot of management time, a lot of investment, and our belief is that that money, those funds plus management time, can be invested elsewhere a lot better into the future. You won't see us investing on all of our other retail because we do believe there's recovery there, but ANFA specifically does not fit into the investment strategy of Grit today and into the future. So whilst we have got an interesting offer, it is something that we are considering. We won't sell it off at any price. I think that's really important to note. But those are the core strategies of why we would want to and why we are considering disposing ANFA.
Oh, apologies, I was muted. I think just to add to that, I think that's the point. There is place for retail in our portfolio. ANFA is a really good asset, a really interesting asset, but I think the strategy of the group is to reallocate the time we're spending as well as some of that capital onto some of the industrial and sort of infrastructure assets that we've spoken about in the pipeline. I think it links into the other question, Bronwyn, just if you can give an update on the closing of the transaction. We obviously announced that in December we were expecting something to have come through. Omicron did hit us in December, so there's been some delays, but I think the question is, can you give us an update on expected closing or announcements of further steps in the process?
Yeah, so thanks, Darren. I think Darren did allude to the fact that we, with borders closing and that at the back end of last year, specifically around Morocco. So the due diligence has actually effectively been completed. We are negotiating around certain requirements of the transaction. So we are expecting an offer quite soon. As I said, we won't consider any price, so that's really, really important. We need to ensure that we maximize valuation, which is really key. But we are hoping to see something in the up and coming weeks around the closure of that particular transaction. And hopefully we'll be announcing something quite soon.
Great, thank you. So I'm going to go to the first live question. I'm going to see if I can ask Roy Campbell to unmute, please, or if the moderator can ask. Oh, there you go. Roy, you're live.
Morning, Bronwyn. The pipeline with the data centers, the new focus on data centers, infrastructure, embassies, etc. Does this enable you to look at other interesting countries or geographies that you're not currently in? And, what work are you doing there with that in mind?
Yeah, thanks, Roy. I think what is really key again around those data centers and embassies is that the focal point is the ability to deal with global tenants. So as you see, our main embassy focus is the US Embassy. The ability to extrapolate hard currencies is really, really key. That does lead us into other jurisdictions. So some of the GERA Pipeline that they are looking at in Focus Part 2 does bring in other geographies and other jurisdictions. But again, the focal point is they still sort of have to work in relation to the margins of safety. So investing in countries that we can take money out of is really important. The ability to secure hard currency leases. So the other jurisdictions that are coming about, specifically around American Embassy, that will be considered as a Part 2. But where we are currently closing on the GERA portfolio, which is funded today and has been completed, is the Ethiopian American Embassy. The new jurisdiction, as you correctly said, Roy, that's come in under a GERA perspective is Nigeria, under the data center. So Grit hasn't historically invested in Nigeria. But again, multi-global tenant, hard currency, collections of dollars, those were key parameters on that particular asset itself. So those are sort of new jurisdictions that you will see. But again, focusing on tenant strength is the most important.
And the ability to extract dollars, I think, as you've alluded to there, Bronwyn. So they're in tax-free zones, they're ring-fenced. And I think as long as they meet the criteria of GRIT's sort of investment risk gates, I think those are the ones that were on the table. Bronwyn, can we move over to potentially a question on sustainability? Given that we have such a strong focus on sustainability, with having Total as one of our largest corporate tenants, how does that square with our thinking about how we're contributing to the improvement of the global economy?
Yeah, so I think it is an interesting one. I mean, I think it's been something that we've actually been deliberating across the portfolio and quite a few of our tenants. I mean, we look at data centers, we look at the power supply to data centers, where that's actually coming from, and that all goes in line with sustainability. So yes, we do have we obviously are focused on Total. Total is one of our other many tenants, and it's really important that we not only have our sustainability practices, but our tenants as well. So, and when it comes to securing DFI money, specifically IFC, they put further stringent controls and checks. One is that we need to ensure that we understand our tenants' sustainability programs. We need to be able to work with those. And that's what we do with tenants like Total and other tenants in the portfolio that might be there today or might be there tomorrow. Bearing in mind that, there are tenants that have different parameters and different contextualization sustainability to what we might have. It's about one, not being overexposed to those tenants, but also really working hand in hand with those tenants around their particular programs.
Thank you. I think we struggled a little bit with your signal at the end there, Bronwyn, but I think key is I think we have a base where our future assets continue to be focused on improving our position. And as you can see, our targets are to reduce our overall carbon emissions by 25%. And so I think if you look at what we are doing and all future assets that we acquire, that whole process of bringing our total carbon emissions down by the 25% is our key focus. And as Bronwyn said, we work with our tenants. Sorry, Bronwyn, we lost you a little bit with your signal there, so I thought it was worth
No, that's fine. Thanks, Darren.
Okay, so let's go to the next question, maybe one for Leon. So obviously we've indicated a corporate bond issuance, and I think many of the audience will appreciate, with rates having sort of risen recently on the back of inflationary expectations, that we might be getting slightly priced out. But the question is more around if we're now going to a syndication structure, can we elaborate on what that might mean for cost of debt? And ultimately, how does that play into our vision of an ultimate corporate bond one day? Back to you, Leon.
So I think the markets have run away with us in terms of the actual pricing of the bond over the past few months. I think the inflationary pressure that's coming in and the pressure that's placing on specifically the software rates going into the future are things we need to take into consideration quite well. The key thing is the banks are always going to be a cheaper cost of funding than the bond market for us, for two aspects. The one is just the actual general coupon rate we'll end up paying. But the second thing is the ability to have some debt placed in country, which then gives you the benefit of not suffering any withholding taxes that cross border. So all of these aspects have to be taken into consideration. However, having an ability to cross-collateralize debt is quite important in terms of managing your cost of funding. What we did as a first round of cross-collateralizing our assets was when we did the Mozambique portfolio, which was run by Standard Bank with ABSA behind them. That resulted in a net cost of funding saving of about 0.5% through the cross-collateralization of those assets. And we see being able to put the balance of our portfolio outside of Mauritius together in a cross-collateralized situation will result in an overall saving on the cost of funding, which would then counteract any increases we would see coming through the markets in terms of increased interest rates, with the added benefit of then not having any leakage in terms of withholding taxes on these structures.
Great, thank you, Leon. Bronwyn and Leon, I think maybe I should take this one, but it's discussions around some of the technicalities of concluding the GERA acquisition. So the question is, it was this person's understanding that one of the conditions of the GERA acquisition going through was that the fact that Grit would raise $135 million of cash in December last year. And as we've said earlier, we only raised 76. When I say only, it was a really good outcome in the market conditions. But what does that mean for the closure of the GERA acquisition? So I think just to point out to everybody that those were all conditions that were set out, but will all have the ability to be waived. So I think both parties just need to waive that minimum capital raise as a percentage. There are a couple of small sort of changes that will be required to do that, and there's a regulatory process that we have to go through in the background currently. So I think, as Bronwyn has alluded to, these conditions all have the ability to be waived, but we just need to ensure that they are fully crossed off and fully agreed with all the various parties. There is a long stop date of the 31st of March 2022, which we are currently working towards, and we'll have to update the market with regulatory news service announcements at the appropriate time. And so unfortunately, we can't say too much more about it, except for the fact that we're working hard on closing that by the 31st of March, and we'll update the market as soon as we can. Any further questions? I think we've seemed to have run out, and actually, quite frankly, we've only got 1 or 2 minutes left before Bronwyn needs to run off. So unless there's any final questions that need to come through or any further hands that need to be raised, I suppose you have your chance now. Otherwise, and I haven't seen anything come through. So maybe, Bronwyn, let me hand back over to you just for a couple of closing remarks. And obviously from our side, any further questions, please reach out to ir@grit.group. That's ir.grit@grit.group, and we can do further follow-ups if required. So back to you, Bronwyn, for the close.
Thanks, Darren. And I'm hoping my signal's okay, because it's managed to be okay. So hopefully you can still hear me. So I think just to maybe some passing comments, thank you to everybody. Thank you for joining this call. As Darren mentioned now, if there are any further questions, we will be speaking to some of the investors in person, but please reach out to ourselves. We are really excited around, as I mentioned earlier, around the initiatives that have been concluded, and some of them are currently underway, and the impact that those have on the business, specifically liquidity, balance sheet, operational strength of the portfolio going forward. And we are really excited now around the leveraging of what we have done to date as a management team. So on that note, we'd like to thank everybody. Thank you for joining us on behalf of Leon, myself, Darren, and the board. We look forward to working with our investors and our key stakeholders into the future. Thanks so much, Darren.
Thank you, everyone.